Welcome back to CryptosRUs. I am George. We're all George. So, happy Friday. Hopefully, it's a happy Friday. Today's the big Jackson Hole Summit announcement. Okay, it's coming. So, let's talk about what to expect, how it's going to affect markets, and more. All right, let's do it, guys. Let's do it. Welcome. We are starting out the day a little bit weaker than yesterday at 112. And the U.S. market is actually green right now, except NASDAQ Tech. Tech is barely green, but there's been a lot of volatility this week. Okay, it hasn't been a good week. We had basically 4 or 5 straight red days. Same thing with Bitcoin and crypto coming off our recent highs. And that's because everyone's waiting for this speech. And that's coming in 30 minutes. Supposedly, this speech is coming at 9 a.m. Central or 10 a.m. Eastern. And you know what? I think by now you guys know why why this is so significant. Is because this is going to be his last. This is going to be his last one. Okay, there's almost no chance. If there was a prediction tool, there'll be 0% chance that there'll be another one for Powell after this one. And basically, he's going to deliver his last keynote address and set the tone for the Fed for the next year. Everyone wants to hear whether he and others are hawkish or dovish, how many more rate cuts to expect for this year and next year, and overall what he sees in terms of the economy, jobs, tariffs, inflation, all that stuff, right? So that's what everyone's waiting for. Now, the CME prediction tool is still predicting that there's a good chance for a cut in September. 71.6% chance. Although that's down over 25% from just a week ago. We were at 96%, above 96% just a week ago. We have fallen back down to 71.6%. So it really depends on what he says today and how Wall Street interprets it, because this could drop dramatically if he puts on a hawkish tone saying, well, we think that inflation is going to continue to rise and we just can't cut at this point. If he says something like that, it's going to be absolutely horrendous. It's going to be bad. However, if he stays the course and he's like, well, you know what? We recognize tariffs maybe causing inflation to go up, or maybe inflation is going up, but jobs are also suffering. So we have to take that into account and we have to take action. So we will most likely have a cut in September and then another one at the end of the year. If he stays the course like that, it'll be very, very positive. Very positive indeed. So we'll see. We'll see what happens. We only got to wait. Like, it'll be even during the stream when he starts talking. We may just watch it live together. But you know what? Trump, I think he's a little nervous because he's set to make some kind of mysterious announcement today, later on at 11 o'clock. So roughly like 2 hours after Powell. People are speculating this could be, announcement for the war or ceasefire or something. I'm assuming that this has to do with the Fed. I'm thinking it has to do with the Fed. I think Trump is very nervous about Powell being very hawkish and how it could crash markets, and that's why he has this mysterious announcement today. Or maybe it is about the ceasefire. He's just like, I think he's wants to bring some good news in case there's bad news. So that's how I'm taking it. Because the timing of this is not coincidental. So anyways, Yeah, so that's it. We got to wait. We just got to wait a little bit to see how things are. But keep in mind, even if it's bad, okay, even if it's bad, doesn't mean that all gains will be wiped out. Okay, it doesn't mean that a bull run is over. It may just set things back a little bit. Ultimately, let's not forget why Bitcoin was created. Okay, it was created because of all these shenanigans. And there's always shenanigans. Every 10, 20 years, there's some kind of disaster or there's some kind of moment that crashes markets and the world panics and this and that. The Fed has to step in by raising rates or cutting rates or bailing out banks. There's always something. This is why Bitcoin was created. Okay. And if you really want to opt out, you opt into Bitcoin. That's really the end game for most once they understand. All right. Outside of that, let's see. In terms of tariffs, Japanese car makers say that they aren't raising price in the U.S. That's good. Japan just released their export data, I think yesterday or the day before, and it was absolutely horrendous. It was like the worst export numbers in decades. So many countries are really, really struggling right now. Now, you can't say it's all due to tariffs, but it just goes to show that the world is still recovering from post-COVID. I know that seemed like it was so long ago, but things are still kind of off from it, right? And numbers aren't so good. And jobs ain't so good either. So, yeah, we'll see. We'll see. Coming back to Bitcoin and crypto, what is there? Department of Justice says that they will not prosecute decentralized projects developers as long as they don't have any criminal intent. This is very good. Very good indeed. That means if you're a developer, you no longer have to be afraid of going to jail or being sued, as long as, you're not trying to rip everyone off. That's really what it comes down to. Now, if you're trying to rip everyone off, and they can prove that, then of course, you're still doing something illegal. But in the past, Gary Gensler thought everything was illegal, so that's why everyone was being thrown in jail, like the founders of Tornado Cash, right? They just threw them in jail. But it seems like they're not going to be doing that anymore. So very positive. Very positive indeed. What else is very positive? Well, Bitcoin's inflow yesterday was not positive, 195 million outflow. However, this is shocking. Ethereum's was at 288 million, mostly from BlackRock. So BlackRock is loading up again after 4 days of outflows. So that could mean something. That could be a turning point, right? Especially if BlackRock's loading up. So that's interesting. Very interesting. I guess we'll have to see what happens today, but it goes to show you BlackRock's not stopping. This is why alts are still so strong, why Bitcoin dominance isn't flying up like normal, because you got a lot of institutions now loading up on alts like ETH now rather than solely on Bitcoin. Today also, there's $5 billion worth of Bitcoin and Ethereum options set to expire. So this probably has a lot to do with the volatility we've been seeing, right? The up and downs, the market makers liquidating people left and right. A lot of it also is to hit these targets for options. So whenever we have that, and the weird thing is, it's not even the last Friday of the month. Next Friday, next week, will be even bigger probably. Usually the last Friday of every month, you get the most volatility. So I guess we'll see next week. What else? Philippines, just like Brazil, thinking about creating a strategic reserve for Bitcoin. That's pretty big. And of course, you still have companies that are buying. You got this other company from Japan that just bought 200 Bitcoin out of the blue, and now they have 365 Bitcoins. Right? So, in terms of the believers, the ones that believe, they will continue to DCA. It doesn't matter what happens. Powell's not going to scare them into not loading up. That's the right way. Don't let short-term distractions take you away from your future, your life-changing wealth or financial freedom or generational wealth, whatever you want to call it or whatever your goals are. Don't let short-term distractions steer you away. Okay? And certainly don't sell to BlackRocks of the world. They don't need any more. They certainly want your portion, just like real estate and just like precious metals, just like anything, equities. When they enter, they dominate. And they want to take it. They want to control the market. They want to do so with crypto now. That's why they've been so heavy into Bitcoin, now so heavy in Ethereum, and soon with the other crypto ETFs, they're getting that as well. Crypto's meant for the people, not for institutions, but they're coming in very fast. You don't want to sell them your piece. They don't need it anymore. Strategy also, they may be added to S&P 500 next month, so that will be very positive. A lot of crypto companies are starting to get added, which is good because it automatically means they get included into thousands and thousands and thousands of other ETFs. So, very good. Very good indeed. So I guess right now, from a chart perspective, Bitcoin is still looking very good, bullish, bouncing off of this line right here that we have bounced off of before. Now, if we have a catastrophic fall, can we fall to that blue line, which is sitting right above like 100,000? Sure. Is it likely to happen? No. We have seen this many times before. Here's something else, a retest of the top of the inverse head and shoulders. You know, there's a lot of patterns, a lot of signals that show that this is perfectly normal. We're going through a little distraction, but we will get through it and continue forward. All right. Nothing's going to stop that. And everything is still on track. This is also interesting. Outside of Bitcoin, the EU is exploring either Ethereum or Solana for their digital euro. That's right. That's right. So they are going to have a CBDC, it seems like. And they're not launching their own chain. They're going to put it on ETH or Sol. Or maybe both. Very interesting. That would be absolutely huge for whatever chain they choose. That's going to bring billions upon billions of transactions over the years. And I don't think Ethereum right now can handle it, but they have to look at them. If they chose Solana, it would be huge. Absolutely huge. What else is there? Stablecoin, South Korea's top banks have met with Tether and Circle. They're going to explore how they can use stablecoins for their cross-border transactions. That's big. What's also big is Ferrari now accepts ETH. So if you wanna buy a nice new Ferrari, you could do so. You could do so with your ETH. I don't know if this is the time. I mean, ETH is not that far off from all-time high. So if you're a ETH whale, why not? Why not? Yeah, and recently also there's been a lot of whales. A lot of whales loading about ETH. Just yesterday or the day before, I covered how some old Bitcoin whale sold off a bunch of his Bitcoin, hundreds of millions, like 260 million worth, and he placed a 10x long on ETH. Think about that. When you're that rich, I don't know why you have to risk it. That's just, I just don't get it. Anyways, that's it. Let's see. We're all waiting. Right now, things are looking good. I don't know if Wall Street is anticipating some good things coming out of this speech. Right now, things are green. Very green. We got 15 minutes to go. 15 minutes to go. All right. Let's do some Q&A. Got a lot of people in here. A lot of people laughing about how today is going to be very, very bad. I don't know. I think it's a 50-50 chance. It's not, yeah. I think it's a 50-50 chance. Zaddy, because this is not pure, we're not in pure altcoin season yet. Yeah, there were times back in 2021, maybe not 2022, 2021, my live viewers were between 5,000 to 7,000. I think peak I had was like 12,000 one time, or a couple times. I think when we first broke 100K, I had like 12,000 people. But yeah, but alts have not been good since then. Yeah, I was thinking I shouldn't have worn red. This is not me thinking it's gonna be a red day, but you know, I just picked it out. Adam Bates, it was called Snowfall. It was on FX, but you could watch it on Disney Plus or Hulu. It was a really good show, except the ending. I hated ending, but it was a really good show. BMNR. I'm not sure what that is. Though the bit miner, is that the bit miner? I mean, if it's if it's bit miner, which I think it is, I didn't even know they were traded. I thought it was just a private company. I'll watch it. They had a huge spike in July, and now they've kind of settled. I don't know. It'll be interesting. If more people load up on ETH, then it could be a good play. Is the launch of Ramses DEX on Hyperliquid similar to Arrow on Base? I'm not sure. Never heard of it. Yeah, I'm trying to figure out the ending of Snowfall. I'm trying to figure out who was the cause of Franklin's downfall. I think you can interpret it many different ways. What was the turning point? First of all, I hated Teddy. You could say it was when the ant. Well, you could point to many things. First of all, it goes to show, if you watch them show, don't get family involved in business. Okay, there's that saying, don't get family or friends involved in business, because eventually you're gonna have a falling out and you're gonna lose them. So that's number one. Franklin trusted his family a little bit too much, and that ultimately led to them splitting off because they wanted to run things. They were a little jealous. So that was number one. Number two is Teddy. It was really just Teddy cutting Franklin off and stealing his money. First of all, I don't think it's that easy to just steal that much money from all the banks. There's no way those banks would just allow him to transfer it out. So that didn't make a whole lot of sense. But obviously, he played a big part of it. Franklin's own obsession played a whole bunch of it. He was still fine, it seemed like. No, I didn't fart. It's just a chair like this. It makes noises. His wife also screwed him, but that was also because of Franklin's obsession. I don't know. I think the biggest point in that is, if you go build something, build it alone, and don't trust people too much. I think that's what it comes down to. Just like in business, a lot of people get ripped off, okay, by their partners, because they get a disagreement, the partners go split off and create their own thing and compete and whatever. I think you just got to go alone. Is the speech on yet? I don't think it's on yet. I think they'll put it here. Oh, here we go. Starts in 6 minutes. When do you think we'll see all-time highs with Powell's BS? It really depends on what he says. If he says good things, if he remains dovish, then we could see all-time highs today. We could jump right back up. This is the only reason why we came down. But if he's hawkish, we'll probably go down more. Do you like DeLorean? First car with the crypto wallet? No, I don't. I haven't tested the new one, so I can't say. But I don't know. I would love to get an original DeLorean. We got like almost 4,000 people in here waiting. Right now, markets are looking good. I think Wall Street expects that whatever he says is going to be good. Otherwise, we'd be deep in the red right now. So Wall Street thinks it's going to be good. Franklin in this show is exactly like Heisenberg in Breaking Bad, right? I love shows like that, where it shows like one guy getting to the top, starting from nobody, building his way to become the top and building an empire and being really good at what he does, or the best at what he does. I love shows like that. Three minutes. So while we're waiting, I have this other idea for my, totally different for content, for cars, for drivers only. I'm thinking about picking up like iconic 90s cars that are not too expensive, getting like really high mileage ones or ones that are like, that needs work, and then creating content around them by like fixing them up, getting them back to their original shape, and then selling it and see if I can make a profit by reselling it. So it's almost like a flipping show idea, but there's going to be a lot more content around like getting it back, right? Back to normal, modifying, fixing, whatever. Do you guys think that's a good idea? It mostly make it like short form base. It could be some long videos. You guys think that's a good idea? I think that would be a good idea. But it has to be like affordable cars. I can't, be getting like a 100K NSX doing that. It has to be like, I was thinking like, maybe like the S2000. They're like in the 20s. Or like Civic hatchback or Civic SIs. I think they're much less. They're under 15, 10. Even I saw like you could get like old M3s for that price. Oliver Strong, you're banned from this channel. Chill. I think R34s are really expensive still. Maybe 33s. I've seen some R33s and 32s for cheap. 34s are too much. Seems like most people like that idea. I like that idea. It's going to take a lot of time, but I have a lot of time in my hands these days anyways. Is this starting or not? Yeah, I think Eagle Talons. I don't know, like it has to be cars people also care about today. I don't know about I remember those Mitsubishi Eclipses were really popular, the Talons, but like I don't think really people care about them anymore. I saw this person do it on Integras, and yeah, I remember everyone loved Integras back in the day. Maybe there's some of the old Mustangs too, like the Fox body Mustangs. I don't know if anyone cares about Fox bodies anymore. How are there breaking news when this is not starting yet? Or is it not? Is this not going to show it? Powell indicates conditions may warrant interest cuts as Fed proceeds carefully. That sounds pretty dovish to me. Or the headline, at least, is written to be dovish. Is he caving? That's what it sounds like. He's caving. Oh, we just jumped up $1,000 right there. Yeah, I think he's like, I had enough. Just give people what they want. How is that released and he's not talking? Where is actually the live press conference? Oh man, the shorts are gonna get absolutely rocked today. Let's see. Yeah, we're gonna smash through that. We're probably gonna get 115s, and then there's not a lot up here. We just shoot right back up to 120. Let's see the prediction tool. Prediction tool went up 75% now. Still going. Oh, here we go. Let's play this. Still going.
In my remarks today, I will first address the current economic situation and the near-term outlook for monetary policy. I will then turn to the results of our second public review of our monetary policy framework as captured in the revised Statement on Longer-Run Goals and Monetary Policy Strategy that we released today. When I appeared at this podium 1 year ago, the economy was at an inflection point. Our policy rate had stood at 5.25% to 5.5% for more than a year. That restrictive policy stance was appropriate to help bring down inflation and to foster a sustainable balance between aggregate demand and supply. Inflation had moved much closer to our objective, and the labor market had cooled from its formerly overheated state. Upside risks to inflation had diminished, but the unemployment rate had increased by almost a full percentage point, a development that historically has not occurred outside of recessions. Over the subsequent 3 Federal Open Market Committee meetings, we recapped stance, setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the longer run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity. There is significant uncertainty about where all of these policies will eventually settle and what their lasting effects on the economy will be. Changes in trade and immigration policies are affecting both demand and supply. In this environment, distinguishing cyclical developments from trend or structural developments is difficult. This distinction is critical because monetary policy can work to stabilize cyclical fluctuations, but can do little to alter structural changes. The labor market is a case in point. The July employment report, released earlier this month, showed that payroll job growth slowed to an average pace of only 35,000 per month over the past 3 months, down from 168,000 per month during 2024. This slowdown is much larger than assessed just a month ago, as the earlier figures for May and June were revised down substantially. But it does not appear that the slowdown in job growth has opened up a large margin of slack in the labor market, an outcome we want to avoid. The unemployment rate, while edging up in July, stands at a historically low level of 4.2% and has been broadly stable over the past year. Other indicators of labor market conditions are also little changed or have softened only modestly, including quits, layoffs, the ratio of vacancies to unemployment, and nominal wage growth. Labor supply has softened in line with demand, sharply lowering the break-even rate of job creation needed to hold the unemployment rate constant. Indeed, labor force growth has slowed considerably this year with the sharp fall-off in immigration, and the labor force participation rate has edged down in recent months. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. At the same time, GDP growth has slowed notably in the first half of this year to a pace of 1.2%, roughly half the 2.5% pace in 2024. The decline in growth has largely reflected a slowdown in consumer spending. As with the labor market, some of the slowing in GDP likely reflects slower growth of supply or potential output. Turning to inflation, higher tariffs have begun to push up prices in some categories of goods. Estimates based on the latest available data indicate that total PCE prices rose 2.6% over the 12 months ending in July. Excluding the volatile food and energy categories, core PCE prices rose 2.9%, above their level of a year ago. Within core, prices of goods increased 1.1% over the past 12 months, a notable shift from the modest decline seen over the course of 2024. In contrast, housing services inflation remains on a downward trend, and non-housing services inflation is still running at a level a bit above what has been historically consistent with a 2% inflation. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. It's also possible, however, that the upward pressure on prices from tariffs could spur a more lasting inflation dynamic, and that is a risk to be assessed and managed. One possibility is that workers who see their real incomes decline because of higher prices demand and get higher wages from employers, setting off adverse wage price dynamics. Given that the labor market is not particularly tight and faces increasing downside risks, that outcome does not seem likely. Another possibility is that inflation expectations could move up, dragging actual inflation with them. Inflation has been above our target for more than 4 years and remains a prominent concern for households and businesses. Measures of longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored and consistent with our longer-run inflation objective of 2%. Of course, we cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem. So, putting the pieces together, what are the implications for monetary policy?
Here we go.
In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
Ooh.
Monetary policy is not on a preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks. We will never deviate from that approach. So, turning then to my second topic. Our monetary policy framework is built on the unchanging foundation of our mandate from Congress to foster maximum employment and stable prices for the American people. We remain fully committed to fulfilling our statutory mandate, and the revisions to our framework will support that mission across a broad range of economic conditions. Our revised statement on longer-run goals and monetary policy strategy, which we refer to as our consensus statement to save time, describes how we pursue our dual mandate goals. It is designed to give the public a clear sense of how we think about monetary policy, and that understanding is important both for transparency and accountability, and for making monetary policy more effective. The changes we made in this review are a natural progression grounded in our ever-evolving understanding of our economy. We continue to build upon the initial consensus statement adopted in 2012 under Chairman Ben Bernanke's leadership. Today's revised statement is the outcome of the second public review of our framework, which we conduct at 5-year intervals. This year's review included 3 elements: Fed Listens events at reserve banks around the country, a flagship research conference, and policymaker discussions and deliberations supported by staff analysis at a series of FOMC meetings. In approaching this year's review, a key objective has been to make sure that our framework is suitable across a broad range of economic conditions. At the same time, the framework needs to evolve with changes in the structure of the economy and our understanding of those changes. The Great Depression presented different challenges from those of the Great Inflation and the Great Moderation, which in turn are different from the ones we face today. At the time of the last review, we were living in a new normal, characterized by the proximity of interest rates to the effective lower bound, or ELB, along with low growth, low inflation, and a very flat Phillips curve, meaning that inflation was not very responsive to slack in the economy. To me, a statistic that captures that era is that our policy rate was stuck at the ELB for 7 long years following the onset of the global financial crisis in late 2008. Many here will recall the sluggish growth and painfully slow recovery of that era. It appeared highly likely that if the economy experienced even a mild downturn, our policy rate would be back at the ELB very quickly, probably for another extended period. Inflation and inflation expectations could then decline in a weak economy, raising real interest rates as nominal rates were pinned near zero. Higher real rates would further weigh on job growth and reinforce the downward pressure on inflation and inflation expectations, triggering an adverse dynamic. The economic conditions that brought the policy rate to the ELB and drove the 2020 framework changes were thought to be rooted in slow-moving global factors that would persist for an extended period. And they might well have done so, if not for the pandemic. The 2020 consensus statement included several features that addressed the ELB-related risks that had become increasingly prominent over the preceding 2 decades. We emphasized the importance of anchored inflation, longer-term inflation expectations, to support both our price stability and maximum employment goals. Drawing on an extensive literature on strategies to mitigate risks associated with the ELB, we adopted flexible average inflation targeting, a make-up strategy to ensure that inflation expectations would remain well anchored, even with the ELB constraint. In particular, we said that following periods when inflation had been running persistently above 2%, appropriate monetary policy would likely aim to achieve inflation moderately above 2% for some time. In the event, rather than low inflation in the ELB, the post-pandemic reopening brought the highest inflation in 40 years to economies around the world. Like most other central banks and private sector analysts, through year-end 2021, we thought that inflation would subside fairly quickly without a sharp tightening in our policy stance, as this slide will show. When it became clear this was not the case, we responded forcefully, raising our policy rate by 5.25 percentage points over 16 months. That action, combined with the unwinding of pandemic supply disruptions, contributed to inflation moving much closer to our target without the painful rise in unemployment that has accompanied previous efforts to counter high inflation. This year's review considered how economic conditions have evolved over the past 5 years. During this period, we saw that the inflation situation can change rapidly in the face of large shocks. In addition, interest rates are now substantially higher than was the case during the era between the global financial crisis and the pandemic. With inflation above target, our policy rate is restrictive, modestly so in my view. We cannot say for certain where rates will settle out over the longer run, but their neutral rate may now be higher than during the 2010s, reflecting changes in productivity, demographics, fiscal policy, and other factors that affect the balance between saving and investment. During the review, we discussed how the 2020 statement's focus on the ELB may have complicated communications about our response to high inflation. We concluded that the emphasis on an overly specific set of economic conditions may have led to some confusion, and as a result, we made several important changes to the consensus statement to reflect that insight. First, we removed language indicating that the ELB was a defining feature of the economic landscape. Instead, we noted that our monetary policy strategy is designed to promote maximum employment and stable prices across a broad range of economic conditions. The difficulty of operating near the ELB remains a potential concern, but it is not our primary focus. The revised statement reiterates that the committee is prepared to use its full range of tools to achieve its maximum employment and price stability goals, particularly if the federal funds rate is constrained by the ELB. Second, we returned to a framework of flexible inflation targeting and eliminated the makeup strategy. As it turned out, the idea of an intentional moderate inflation overshoot had proved irrelevant. There was nothing intentional or moderate about the inflation that arrived a few months after we announced our 2020 changes to the consensus statement, as I acknowledged publicly in 2021. Well-anchored inflation expectations were critical to our success in bringing down inflation without a sharp increase in unemployment. Anchored expectations promote the return of inflation to target when adverse shocks drive inflation higher and limit the risk of deflation when the economy weakens. Further, they allow monetary policy to support maximum employment in economic downturns without compromising price stability. Our revised statement emphasizes our commitment to act forcefully to ensure that longer-term inflation expectations remain well anchored to the benefit of both sides of our dual mandate. It also notes that price stability is essential for a sound and stable economy and supports the well-being of all Americans. This theme came through loud and clear at our Fed Listens events. The past 5 years have been a painful reminder of the hardship that high inflation imposes, especially on those least able to meet the higher costs of necessities. Third, our 2020 statement said that we would mitigate shortfalls rather than deviations from maximum employment. The use of shortfalls reflected the insight that our real-time assessments of the natural rate of unemployment, and hence of maximum employment, are highly uncertain. The later years of the post-global financial crisis recovery featured employment running for an extended period above mainstream estimates of its sustainable level, along with inflation running persistently below our 2% target. In the absence of inflationary pressures, it might not be necessary to tighten policy based solely on uncertain real-time estimates of the natural rate of unemployment. We still have that view, but our use of the term shortfalls was not always interpreted as intended. raising communications challenges. In particular, the use of shortfalls was not intended as a commitment to permanently forswear preemption or to ignore labor market tightness. Accordingly, we removed shortfalls from our statement. Instead, the revised document now states more precisely that the committee recognizes that employment may run at times above real-time assessments of maximum employment without necessarily creating risks to price stability. Of course, preemptive action would likely be warranted if tightness in the labor market or other factors pose risks to price stability. The revised statement also notes that maximum employment is the highest level of employment that can be achieved on a sustained basis in a context of price stability. This focus on promoting a strong labor market underscores the principle that durably achieving maximum employment fosters broad-based economic opportunities and benefits for all Americans. The feedback we received at Fed Listens events reinforced the value of a strong labor market for American households, employers, and communities. Fourth, consistent with the removal of shortfalls, we made changes to clarify our approach in periods where our employment and inflation objectives are not complementary. In those circumstances, we will follow a balanced approach in promoting them. The revised statement now more closely aligns with the original 2012 language. We take into account the extent of departures from our goals and the potentially different time horizons over which each is projected to return to a level consistent with our dual mandate. These principles guide our policy decisions today, as they did in the 2022 to 24 period, when the departure from our 2% inflation target was the overriding concern. In addition to these changes, there is a great deal of continuity with past statements. The document continues to explain how we interpret the mandate Congress has given us and describes the policy framework that we believe will best promote maximum employment and price stability. We continue to believe that monetary policy must be forward-looking and consider the lags in its effects on the economy. For this reason, our policy actions depend on the economic outlook and the balance of risks to that outlook. We continue to believe that setting a numerical goal for employment is unwise because the maximum level of employment is not directly measurable and changes over time for reasons unrelated to monetary policy. We also continue to view a longer-run inflation rate of 2% as most consistent with our dual mandate goals. We believe that our commitment to this target is a key factor helping keep longer-term inflation expectations well anchored. Experience has shown that 2% inflation is low enough to ensure that inflation is not a concern in household and business decision-making, while also providing a central bank with some policy flexibility to provide accommodation during economic downturns. Finally, the revised consensus statement retained our commitment to conduct a public review roughly every 5 years. There's nothing magic about the 5-year pace. That frequency allows policymakers to reassess structural features of the economy and to engage with the public, practitioners, and academics on the performance of our framework. It is also consistent with several global peers. To wrap up, I want to thank President Schmid and all of his great Kansas City staff who work so diligently to host this outstanding event annually, counting a couple of virtual appearances during the pandemic. This is the 8th time I've had the honor to speak from this podium. Each year, this symposium offers the opportunity for Fed leaders to hear ideas from leading economic thinkers and focus on the challenges we face. The Kansas City Fed was very wise to lure Chair Volcker here to this national park more than 40 years ago, and I am so proud to be part of that tradition. Thank you very much.
Oh, there's no Q&A. The clap doesn't need to be this long.
Thank you very much.
All right, guys. Gotta summarize what he just said. A lot of things, very, very interesting. Very interesting. Basically, he's recognizing that the Fed has to change. They have to adapt to the times. I don't know if you guys picked up on what he was saying, the ELB. He kept saying ELB, we're going to get rid of the ELB. I'm like, what the hell is the ELB? I just looked it up. It means effective lower bound. It's a problem that the Fed is worried about when the economy is struggling and rates are at zero already. So basically, you can't lower the rates anymore because it's already at zero. We had that problem during or leading up to the pandemic when rates were at zero already. So he was saying how the Fed is really cautious about ELB, effective lower bound, but he just said, we're not going to follow it anymore. We're not going to worry about it anymore because ultimately the most important thing is price stability and jobs. So he basically said, like, we're not going to worry about things that we were worried before. We're going to change our policies, basically. And we're going to focus on jobs. And he mentioned about how the revisions that came in July for June and May showed we were only adding 35,000 jobs per month, which is way lower, way lower than the previous estimates. And then he mentioned about tariffs and, you know, like the inflation and all that, but they're all like, you can't predict them, right? But what you can predict is a slow economy, slow jobs, and if people aren't working, you know, obviously the GDP goes down and all that stuff goes down. So that was pretty dovish. He also, the biggest thing was that, you know, conditions may warrant interest rate cuts, which opens up, right? Which basically says they're going to discuss, but they're definitely open to rate cuts. It's not like he's saying, no, we're not even entertaining rate cuts. So that was as good as a speech as one could hope for. That was probably the best one could hope for. He said a lot of stuff. I mean, this is why I don't cover FOMC press conference anymore, because he just like talks forever and goes in circles. But ultimately how I took that was, yeah, they're going to ignore a lot of stuff now and really just concentrate on jobs. That jobs report really saved us. The jobs report, the revision downward, really made them rethink their stance, basically. That was fantastic. I think it's also partly because he knows this is his last year. This is his last speech. He's going to have to step aside, right? And he just more or less going with the flow. We got a good pump. Good pump because of it. Let's see how much we could hold. ETH jumped up 8%. And everything else jumped up tremendously here. We got a lot of shorts liquidated. I mean, we went all the way up here. See, all this right here, all gone. We really don't have that much holding us back to getting back to 120. We really don't. If Wall Street decides to like FOMO right now, which they tend to, they're very reactionary. If Wall Street's like, all right, we need to go all in because we've been selling off so much the past 5 days. Yeah, it's going to be good. But the thing is, you know, Trump is supposed to give some mysterious announcement in a couple hours. But I think he may not anymore because I think he was just really afraid that Powell's going to screw up markets more. I really think that he was just afraid that it was going to be really bad and he needed to come on and say some good things. I don't know. Or maybe he'll come on and congratulate Powell. Look at that. We're back to 91%. We were at 70% and we jumped up 20%. I want to see what Trump tweets out on Truth Social about what Powell just said. I think it'll be very good. I think we could see 50 basis point coming. I don't know. Maybe not. He's not that dovish, but you know, in October there's a 43% chance of another rate cut. That was fantastic, guys. That was fantastic. Again, it goes to show you got to stay in the game. You got to stay in the game. If you sell out, you would have missed all this, right? HODL, DCA, HODL, DCA. That's all you got to do. That's all you got to do. Look at ETH coming back to 4,600. It's like, it's only $200 away from all-time high. ETH is blowing up right now. Bitcoin dominance down a percentage. I mean, Bitcoin dominance just continues to go down. We're below 59%. We're at 58% now. We're definitely in altcoin season. Yeah, I guess red shirt actually in this case means lucky. Well, according to my zodiac, my Chinese zodiac, I should be wearing red, gold, brown, like yellow. I don't know if I should. It's like more of the reddish colors. It's my lucky colors. I should wear red more. Oh, now we've broken above this trend line, which is really good. We generally, right? We generally been bouncing off of there. We came down a little bit like this time. Now we're coming back above. Sid, appreciate it. Heath, appreciate it. Ricardo figured it out. All right, guys. I guess on that note, I'm about to change the title and change the thumbnail of this video. It was good, guys. I may have more thoughts tonight, but basically that went terrifically. It could not have gone better based on what he said. To sum up, they're going to stop worrying about the ELB. They're going to change their policy. They're going to focus on jobs and the economy. And the best way to do that is by cutting. They're going to basically ignore inflation at this point, even though it's a dual mandate. But still, jobs more important than inflation at this point. All right, guys, smash the like, subscribe to the channel. I'll see you guys tonight. Take care. Bye-bye.
What do you think about Ripple?
Well, I mean, I think it's too centralized, but I definitely want to meet Chris Larson.